Welcome to XYPN Radio, where your host Alan Moore brings you into a community of fee-only financial planners who want to profitably and successfully serve Gen X and Gen Y clients. If you're ready to get the knowledge you need from leaders in your field, learn from forward-thinking advisors, and take action on your own goals, XYPN Radio is the show for you. Here's your host.
Hello, and welcome to this episode of XYPN Radio. I am your host, Alan Moore, and today it's my pleasure to bring you an interview with Steve Dunlap, the president and COO of FolioDynamix. Steve has spent his entire career in financial services, with the majority of it in technology, helping advisors better run their businesses. His position as COO means he lives on the operational side of the business, and his main job is to keep the wheels on the bus, as we like to say here at XYPN about our COO. We had a great time talking about a lot of different topics, including when advisors should consider professional management for their firm and what the younger advisors should look out for to see if their firm owner is serious about succession, the future of independent broker-dealers, and Folio's outlook on the future of financial planning, which includes their term, Fiborg, which I think will resonate with most listeners. I'll be interested to hear from all the listeners on if you agree with his predictions. You can find any of the additional resources we mentioned during the episode at xyplanningnetwork.com/73. In addition to the typical resources, you'll find a link to our recently launched book, co-authored by Kitsis and myself, titled The Monthly Retainer Model, What It Is, Why It Works, and How to Implement It in Your Firm. FolioDynamix is leading the evolution of the wealth management business with technology and advisory solutions that empower every advisor. FolioDynamix just launched the concept of Fiborg, which covers those advisors who embrace technology automation the same way the cyborgs of science fiction did. That Fiborg concept means that advisors can automate those activities that don't generate revenue while maximizing the time they spend with clients. For more on Fiborg, on working with millennials, and on FolioDynamix, visit FolioDynamix.com/thought_leadership. Also, be sure to go to xyplanningnetwork.com/VIP to join our private Facebook group just for XYPN Radio listeners. You can interact with other listeners, ask guest questions, and more. Without further ado, here's my interview with Steve. Hey, Steve, welcome to the show, man. Thanks so much for being on.
Thank you, Alan. I'm very happy to be here.
Yeah, I'm excited because we don't have a lot of non-advisors, I guess, on the show. So it's always interesting to hear kind of what outside folks are, not outside, but non-advisors are working on in various technology solutions and also kind of get opinions on industry trends. So I'm excited to dig in. So like usual, take us back and just kind of talk to me a little bit about kind of your career path. How did you get into the financial services industry?
From the time I was a small child, I dreamed about being a financial technology and wealth management executive.
Of course, because what else would you want to be besides that and firefighters?
It was either that or firefighter. It was down to the wire. But, like most things, it was kind of by accident. I graduated college back in 1989, and it was a rotten job market. And I ended up accepting a job going into the management training program for a retail bank, First Virginia Bank, which no longer exists. The pay was terrible, and they taught you how to be a teller and then an assistant branch manager and open checking accounts. And it was a good place to, get something. At least it was a job when there were not a lot of jobs available coming out of school. But I quickly figured out that was not what I wanted to do. And I kind of had stars in my eyes about being a stockbroker. That's what we used to call them, right?
Sure. That was the thing then.
So I literally opened the yellow pages and called every brokerage firm in town and said, hey, I'm a banker and I want to be a stockbroker. Will you talk to me? Well, I didn't know what I was doing. It was by sheer luck, but I was cold calling branch managers. And as it turns out, they wanted guys that would make cold calls.
They were comfortable and good at selling themselves in 30 seconds.
There you go. So I quickly ended up with offers to go to Legg Mason or Dean Witter in those days or Merrill Lynch. And I selected Legg Mason, and they had a wonderful training program. And I went and I got my Series 7 and went through their training program. And what I learned quickly was I didn't like being a broker. It was tough. The cold calling was hard. It takes a long time to build that business. As all of your listeners know, I have so much respect for the people that have built great practices and great business around that, because I know how hard it was. And I wasn't good enough.
Neither were most people. I mean, the actual attrition rates there are absurd. So, that was not, it was very much a churn and burn training strategy as they knew because they brought in just tons of people into those training programs.
That's right. And boy, 75% of the people I went through training with washed out for sure.
That's incredible.
But the silver lining is what I learned being there is I learned what a financial advisor needs. What do they do every day? How do they work with customers? I learned the basics of the industry. I got my licenses and I understood a little bit of that. So I was well positioned when one day, and I loved technology. In those days, I was one of 2 people in our entire branch out of 30 advisors that actually had a computer on his desk. So one day this sales guy comes in the office and he's selling a prototype of a mutual fund illustration package. And the branch manager says, well, go back and talk to Dunlap. He's nerdy like that. You can show him the software. And he starts showing it to me. And I started giving him advice. I said, well, this workflow isn't right. And you need to change this. This should be a drop down instead of radio buttons. And I started telling him how the software should work. And he says, you need to come talk to my boss. And lucky enough, that turned into, I became a product manager for a company that was owned by Thomson Financial, which is now Thomson Reuters. Back then it was much smaller and a collection of sort of entrepreneurial companies. And it was a company called CDA Wiesenberger. And I came in, I was hired by a fellow by the name of Jay Nadler, who was, still a, very successful guy, one of the best mentors of my career. And I became the product manager for this product that they wanted to build because they had a database of mutual funds from this company. Wiesenberger had been publishing books of mutual fund performance in the 1940s on Wall Street. And they wanted to turn that into a software product to compete with Morningstar. So that's what I built.
I always tell listeners have heard me say this, but especially if you're still in college or just starting your career, you got to be open to opportunities because who knew that on some random Thursday afternoon, a tech guy's going to walk into your office, try to sell you on something, and that's ultimately going to completely change your career path.
Isn't that crazy? And it did. That turned me into a financial technology guy. And since that time, I've spent my entire career building technology that's used by financial advisors to serve their customers in one way or another. In that case, it was mutual fund illustrations, but I've done annuity onboarding systems. I've done wealth management platforms. And that career path took me through working inside of broker-dealers and for small technology firms. It's been a great ride.
So what brought you then to kind of your existing position? And I guess, and we'll detail a little bit about what you do here in a minute, but I guess what brought you into Folio?
Sure. Well, after spending, 25 years, I guess, in different roles running, back at Thomson, I ended up, running that division and became more of a general manager. And then over the years ran different businesses that were providing these capabilities. And then I spent time at Pershing and at Cetera. And in both of those places, I was a customer of FolioDynamix. So at Pershing, I actually bought the FolioDynamix platform capability and brought that into Pershing and made it part of the NetX 360 platform there. And then at Cetera, we also used it to build our wealth management platform around. And so having been a customer of the firm a couple times, the CEO, Joe Marak, became a friend of mine. I knew a lot of people that worked there. I knew the company well, and I certainly knew their products, having been a customer. So when I left Cetera, Joe started a conversation and said, we could use more leadership here. We're having a lot of growth. We need to position for that. We need, more people to help lead it. So how about if you come over here and help me out? That's how it worked.
That's amazing. It's just, again, I'm so fascinated by career paths. Listeners are probably annoyed by now that I always get into careers because it's just so crazy that when you're in college, you think of I'm going to get a degree in financial planning. And I'm going to be a financial planner for the rest of my life. And the truth is there's so many career paths inside of financial planning, much less if you, go outside the path and come back in. You can just do so many different cool things. But so just for, I guess, kind of context, so Cetera was a huge independent broker-dealer. Is it still in existence or did it get merged in?
It is. They went through a lot. They were acquired by RCS Capital and then managed to basically spin themselves out of that after there were a few kind of problematic events with that. But they are now the second largest independent broker-dealer. They're independent, they're privately owned, and they're doing great. They're on a very nice path for growth. And there are, what do we have? I guess we had 9,000 financial advisors, so it's a big firm. And that was great experience. I'm really more of a small company guy at heart. That's what I really enjoy. But the experience at Cetera and the experience at Pershing, I learned a lot. And that's been if you're interested in career paths, that's been, I think, a big part of the secret of my success is having done so many different things. I've worked in large companies. I've worked in small companies. I've worked in very technology focused companies. And everywhere I've tried to take a lesson and some experience that I can apply to the next role that makes me just a little bit better, a different perspective, different ideas. And it's the breadth of that experience. So that's always my advice to people is figure out what you enjoy doing and collect as much experience around that and figure out new ways to apply it.
Yeah, it's one of my biggest encouragements. And I find that most successful people that we have on the podcast, they have a few different central, probably core personality traits. But one of them is they are open to opportunity and not just shutting it down because, no, I said I want to be a financial advisor and I need a financial advisory job. There are so many things you can do with a CFP and that you can do in financial planning. And, if you go to a conference, every single vendor there has a CFP. They hire their own, to sell to their own. So it's just being open to opportunity and seeing that, just because you're a small company guy doesn't mean you can't go work for Pershing for a while and kind of see what you can learn and see what difference you can make.
You're right. I'm constantly amazed by the niches out there. I have a friend who is in the business of moving fine art. And so he's got what's basically a moving company, but the only thing they move and package and crate and store is priceless art.
It's crazy specific.
It's a funny little niche, but they do very well. And if you think about career paths, and if you're that college kid you're talking about thinking, what am I going to go do in the world? It would never occur to you that this niche exists. And believe me, he does very well. But that's what amazes me, talking to entrepreneurs, talking to business people. There's so many different ways of coming up through the world. So you really have to figure out what it is that you enjoy. And personally, I've never written a line of code in my life, but I enjoy figuring out how to deploy technology to help financial advisors do better at what they do, because I really believe in that mission. Most people have no idea what to do with their money. You talk to people at a cocktail party, they just have no clue. It's such a needed service. And I look at it and say, if I can deploy technology doing what I do to make advisors a little bit better, a little bit more efficient, a little bit more effective in how they communicate their mission and what they do, well, that's a lot of fun. And I've managed to find a way to do, what I enjoy.
And it makes a difference. I truly believe that in financial planning, we get to say that we help people live great lives.
Absolutely.
I think that's at our core, that's our mission. And for those of us that are no longer advisors, because I'm no longer working with clients either, we get to support advisors, helping them live, helping those clients live great lives. And that's just what's so fun about it is that it always comes back to there is a mission-driven side of our part of the profession. I don't know, honestly, I don't know a lot of folks on the product sales side. I don't know if they sit around and talk about how they help clients, achieve their dreams and live great lives. But I do know the fee-only fiduciary planning focus side does. And in many ways, that's why we got into this business. So, okay, so with Folio, what is your actual role and kind of what is your, job duties there at Folio now?
Sure. So I'm the president, and the COO is the fancy title for the business card. But
does that make you the no guy? Because that's what our COO is. He's my no. He always tells me no. We can't afford that. So
Joe is our CEO, and my joke with him is what that role means is I do all the crap that you don't want to do.
That sounds about right. Raul, our COO, would definitely agree with that.
But, no, Joe's the guy who originally conceived of what this company could be. And he believed that he could do, model-based trading and rebalancing software better than anybody else. And he did. So now what my role is we've gone from a startup when Joe got it started in 2007, and it ran like startups do. When you're a startup, you got a core team of people. There's a handful of you, and you all get in a room and you decide what you're going to go do, and you go do it. We're now at that inflection point, and you can read business books that talk about that inflection point of a business. And maybe it's when a business hits 100 employees. Maybe it's when a business hits $10 million in revenue. You can argue about where the point is, but there's an inflection point where a business has to change the way that it operates. And so the mission that I'm after is to add sort of the rigor and the discipline and the process so that a company can scale without those things becoming bureaucracy that get in the way of that growth. That's what we're trying to accomplish. We're an interesting company because we provide technology and we provide advisory services. We actually manage money on behalf of other people, and we build those platforms that help advisors do that. But shifting to a mid-stage growth company and putting in place the processes, the leadership, the people, and frankly, the cultural changes that will help you take full advantage of that at a high level, that's what I'm up to.
No, I love it because in financial planning, I grew up in the fee-only world. I've never worked for a firm with more than 5 employees. And now, at XYPN, we have, 10 employees. So I've always lived in small business world. And so it's kind of interesting that advisory firms, other than just a very few select few, if they're truly on the fee-only fiduciary side of the house, they don't have 100 employees. I mean, very, very few do. The only folks that really have that are the TAMPs or the providers of the services. So it's interesting that I'm not sure a lot of advisory firms are prepared for the type of growth. I think that's coming. And we'll talk a little bit about this just in terms of industry trends and sort of what's coming, especially with DOL and some changes there. But to go from, just a couple of advisors to even, 10 employees is huge. Once you start getting up in that 50, 100 employee range, that is a highly scaled business that it's tough to run, and you're no longer an advisor. I mean, shoot, you're probably not an advisor after 10 employees, much less after 100. So I'd be interested, I don't know, I guess what are your thoughts on, do you see that coming for advisory firms, that they need to be prepared to scale to 100 employees? Or does can we continue to live in our world of, just a few advisors serving our clients and just kind of hang out?
Let me say it this way. I think the opportunity to scale is absolutely there. It's not even is coming, it's there. So if you're an advisor that's running a business like that, it's really back to the theme of where we started here. You have to decide what you want to be when you grow up. It's still possible and will be forever, I think, to build a fantastic practice that makes a difference in the lives of people and gives you a very nice lifestyle to live. And that is a completely valid choice for a lot of people. But that is, you're an advisor, you're doing what you love, and you're building something that will provide a lifestyle for you and potentially some value of the practice that you can monetize someday when you want to exit and retire. Or you want to run what could become a large business. It's a different thing. And my advice would be, don't stumble into it. Think about who you want to be and what you want to be and make that decision explicitly.
Yeah, and I don't think a lot of folks have that thought early on, and I think it doesn't happen until you're working 70 hours a week and you're trying to hire your first employee, that you really start to realize, we work with a lot of startups. I mean, they are solo practitioners, they're getting their business off the ground, and you're an entrepreneur, you do everything. And then you start to have this look like, I need help to scale and grow. And so I don't know that a lot of people sit down and ask the question of, do you want to scale and grow? Because if you don't have that, I feel like if you don't have that conversation with yourself, you end up in this weird middle ground of like, you are growing, but you're not setting up the systems and processes for continued growth, which you have to have. And then you kind of haphazardly stumble your way through it. And we have high margin, high retention businesses. So you'll get away with it, and it's fine, at least for now. We'll see what the future holds. But it is a good point that if you're a business owner, you have to know what you want to be when you grow up. You've got to set that BHAG, that big, hairy, audacious goal. Like, what do you want it to be? And you can say, I want 100 advisors. And, we have one, Daniel Wren, who was on the podcast just a few weeks ago. He wants to be the premier regional firm that specializes in physicians that are, becoming their residents graduating to become physicians. Fantastic. We have others that say, I want to make $200,000 and that's my BHAG and I don't want any employees. Fantastic. Like, more power to you either way. So
yeah, you just have to know, because it's different things. It's if your business, and that's what I mean about stumbling in. If you're an advisor and the business is growing and you just find yourself working harder to keep up with it, like you talked about, at some level, you simply can't be successful by working harder. There's only one of you. Then you have to figure out, how do you scale the business and put in place the leadership, the organization, the structure, the processes in order to support that business.
Well, and I feel like there's kind of two inflection points we're talking about. One being, when do you start that scaling process, especially as a startup? I mean, you have to, hiring that first employee hurts the pocketbook, I know. But then there's this other level, and we just recently hit this with XY Planning Network, and this is kind of your skill set, is when do you bring in professional management? which is something I don't think a lot of firms are having that thought, for the firms that are scaling. But I think firms wait way too long to bring in true professional management and operations people that just know operations, true COOs that are not advisors. I still see a lot of firms with COOs that are advisors that just kind of, I'll build out the processes. And it's like, I don't know. I just don't see a lot of firms bringing those folks in. And I think it's going to be critical for anybody that wants to grow a business. You've got to be able to have professional management that actually knows how to run a business if that's not your core skill set.
You're right. You're right. Well, in the private equity world, they have a term for this. It's called founder syndrome. And, because the founder of a business became successful because they had an idea and probably a charismatic personality, and they made stuff happen, but it was always about them. If you're going to build into a large business, it can't be about you anymore. Now it has to be about the team. And can you find the most talented people? This is the Jim Collins stuff, right? You get all the right people, get them in the right seats on the bus, build the right organization around them, and making sure you've got the right people that they're willing to lead, that they understand the vision. You have to craft a vision that everybody buys into, and you got to make sure that they're motivated, and then you got to get the hell out of their way. And as a leader, now it's your job to make sure there's a clear vision that everybody subscribes to, and that you've hired people that are willing to make decisions that are sometimes going to be wrong, and that they'll correct them quickly. But it's a very different thing from the founder who is running his business or her business by force of will, as opposed to structuring it's football versus swimming. It's a different sport.
Yeah, and like I said, I think there are a lot of advisory firms that are suffering from this founder syndrome, even as they have grown and have the potential to scale and say they want to scale, and they just don't. But I love ask for forgiveness people. I mean, folks that'll come in, that'll just make decisions, they'll screw things up and then fix it if they need to.
That's right.
Much more than ask for permission, because ultimately, that it's just not the way you can run a business. Otherwise, you're just stuck with a CEO that has to make every single decision. So
one of my standard pieces of advice I give to people that work for me is, I want you to understand the level of authority that you have here. And the amount of authority that you have is the amount that you take until I tell you to stop.
I love it. And this is not how advisory firms are run. And I'm not sure why that is, if it's just that advisors don't know how to scale to that point, or just not willing to let go of the reins, or say they want to grow, but in reality, turning their business into a very nice annuity that will coast into the sunset, through retirement, because it's pretty easy to just serve your existing clients as you retire. I don't know. I'm not sure what the issue is, but we just don't see a lot of firms with that mentality.
Well, I think it's because most people go into that business because they enjoy financial planning. Even if they enjoy stock picking, whatever it is, they enjoy some aspect of the business that they can help people with. They didn't go into it thinking that I'm going to run a business, right? And maybe that's the difference. I look at my career and I think of myself, people say, what do you do? Well, I run businesses. And frankly, I think I could walk into a business where I have little domain knowledge and have done that, and just as a general manager, run that business. Whereas advisors are coming in as a domain expert it's running a business is secondary. And if they think of themselves that way, that's okay. But that's the lifestyle guy I was talking about before, as opposed to think about, Dynasty is a customer of ours. It's a great firm. Ed Swenson, their COO, is a friend. But those guys are dead set serious about, how they're going to build the business, the structures they're putting in place, how they're going to work with advisors, the vendor partners they're going to pick to provide a great service. It's a business, and it's serving advisors and working with advisors, but that's very different from, the guy who's, building that practice.
You make a really great point, because our COO actually came over from technology. He was installing technology in schools, like literally that he was a project manager for a company that did that, and came into financial planning having no clue what financial planners really do or how we operate. And within just a couple of months was making business decisions for us, because again, he knows how to run a business. He knows how to do project management. He knows how to provide leadership for our team. Doesn't mean he knows planning. And I think I'm sure we have a few out there that are in the position, a few listeners out there in the position that this is becoming a question of when do you hire professional management. But I think we have a lot more folks that are inside of firms that are employees that are saying, well, yeah, my firm says they want to grow, but we don't have professional management.
Right.
And I think that's honestly part of why XY Planning Network has grown so fast. I jokingly call them the pissed off junior planners, but it really is that group of folks out there that are saying like, yeah, I was promised succession. I was promised that we were going to grow this thing, that I could take over as owner and scale this thing. But my boss seems to just want to sit back and enjoy his lifestyle and doesn't seem all that motivated to grow the business. And I think those are it's this conversation that we're having for the firm owner, and the junior advisor, associate advisor gets caught in this dynamic of saying I want to grow, but not actually doing what it takes to grow. And I think there's a lot of frustration across the industry with younger planners that are caught in these situations, and they're kind of an innocent bystander, and they're getting frustrated.
Oh, you're right. Well, that's back to it's the founder syndrome. And you look at all the different entrepreneurial companies that are built and funded by private equity, and that ends up resolving itself one way or the other. Some founders are like the example of the person you just talked about. I know you weren't talking about a specific person, but some founders will look at that and they are self-aware enough to say, I know I'm not the guy to take this business to the next level, but I want that growth. So I'm going to step aside, and a lot of times they'll become something like, chief strategy officer or,
right.
But they've got the self-awareness to step aside and bring in professional management. Because if you want to build yourself into a real firm, and you look at, there's no reason why today large advisory practices cannot build themselves to the size of an LPL, for example, because that's where the business is going. But firms like that have to be professionally managed. But the founder either has to become that professional manager or has to be aware that they need to get out of the way. One of those two things. They can't do the middle thing where they keep being the one who runs the business but isn't really running the business, because everyone underneath them knows, which is what you're saying.
Is there a revenue point in your mind that firms need to start evaluating that? Like at what point we hit $1 million in revenue or 10 million or 100 million? Like what, is there a number or number of employees? Is there kind of a standard rule of thumb inflection point?
Yeah, well, there is kind of a rule of thumb that says at 100 employees. There's one at 10. There's a great book on this called Scaling Up.
Oh, I love that book.
It's fantastic. And, if you're going to run a business and try to grow, it's a great read. You read it once and you go back and use different chapters as reference points. And it talks about inflection points of, 10 employees and then 100 employees, inflection points of $1 million and then $10 million and $50 million, if I remember correctly. It's hard to say for an RIA firm exactly at what level of revenue are you talking about, but at $1 million, that's a good lifestyle business that's buying you a comfortable living. At 10, it's hard for me to imagine that you don't need some level of professional management in there. And that's where you have to make that decision of, is that professional management you, or do you want to be an advisor?
Yeah, and for the younger advisors out there working in these firms, I mean, I do think that somewhere around 5 million in revenue, 5 to 10 million, I think you're right that those conversations better be happening. If they're not, then I would question the commitment that the firm owner has to truly stepping out and allowing professional management to come in and take over and help run the firm. But so, I guess just a curiosity. So just so that listeners are aware, talk me through FolioDynamix, and you mentioned just a couple of things that you do in terms of providing technology and advisory, back-end solutions. So just kind of give me a rundown of what does FolioDynamix do, and then we'll talk about a little bit how that kind of ties in with where y'all believe and where you believe the industry's headed.
We're a pretty unique firm. I really don't think there's anybody else out there that's exactly like us. But the easiest way to understand what we do is all of your listeners certainly know what a TAMP is. So think of us like a TAMP, and part of our business is being a TAMP. But the difference is that in our core DNA, we're a technology firm in addition to being an advisory firm. And we have traditionally provided the technology and the tools and the capabilities for other firms to, in effect, become a TAMP, to build a wealth management and a managed account platform. So we have large customers, like Voya is a customer, banks like BB&T, and we have provided them the capability to build their own wealth management platforms that are then private labeled. They can create their own investment programs. So for example, mutual fund wrap capabilities, UMAs, and we're providing the technology in order to do that. And in some cases, also things like overlay trading support, sub-advisory capabilities. So we'll actually structure model portfolios and make those available, and you can private label them for your institution. And that's how we kind of came up in the world, was working with these large enterprises where we're the plumbing inside of their wealth management capability. At Pershing, we run all of the rebalance and the block trading in NetX 360, but we're kind of behind the scenes. We joke about ourselves, we're the guy behind the guy, as opposed to a more traditional TAMP where they have a brand name that's more well known with financial advisors. So that's our history, and we're still very much in that business. But now we also are directly in working with independent advisors and bringing our TAMP capabilities and our technology capabilities that are second to none when it comes to advisors, trading capabilities and doing it themselves. So you can either buy a model portfolio or you can build your own model portfolio and trade your own. So bringing that down and marketing it to the person who's running a $100 million book is not something we traditionally did. It's a business we entered about a year ago. And we actually just announced the acquisition of a business by the name of Summit Advisor Solutions, which was a small TAMP in Dallas that's fairly well established in the independent RIA channel. So that accelerates us with some of the additional capabilities and knowledge and operational support to serve that channel.
I did not realize y'all had made that acquisition. So that was primarily to kind of expand the TAMP services and just kind of ramp that up.
That's right.
Okay, that makes sense. So you kind of have two. So we're talking about two different services. One being very much the technology back end for, it sounds like, larger enterprise level wealth management firms. And then we also have the TAMP, which is more the advisor focused. Your brand is actually in front of them doing investment management services and that sort of thing.
That's right. We call that service FDX Complete. Like I say, it's fairly new. And the way we look at it is it brings, having provided enterprise class services, it's bringing those enterprise class capabilities to the smaller practice where that sort of capability just didn't exist before.
It's the beauty of technology, right? That we can build stuff for the big boys and they actually fund the build out. And the technology is infinitely scalable pretty much. And so you can bring it down to individual advisors at some point and be able to make that functionality available. And that's really the difference between trying to grow a firm on your own and actually building a real business that scales quickly is having the technology that you don't have 18 different systems doing 18 different things and trying to make them all work together.
That's right. And that also shows you our belief in the growth in that fee only and fee based and advisory market. So whether we're helping a large broker dealer with their corporate RIA or whether we're working with the individual RIA, that's we are believers in the advisory business. And of course, everything the DOL is doing right now is just accelerating these trends that were already in place. So a big part of our strategy these days is supporting that.
Yeah, what are you seeing from DOL? Because in our world, DOL doesn't, there's a few minor effects, but ultimately when you're a small fee-only fiduciary, DOL didn't really touch us. But for the big boys out there, so we say we're speeding that shift up. Are you seeing that shift happen? Are people just talking about it? What are y'all seeing from your end that Department of Labor ruling is really going to have on the industry?
Yeah, well, because we work with these large firms, and you've seen large companies like Merrill Lynch has now, announced no more commissions and IRAs. And
yeah, that's amazing. Actually, what amazed me about Merrill Lynch was that they said it only affected 10% of their assets, meaning that they were already 90% of the way there and no one knew it.
Now, that's a perfect illustration of the point that I wanted to make is some people have talked about these DOL changes as if they're earth shattering. And for some businesses, they are. But in my view, while I do happen to think the regulation itself is a little bit more heavy-handed than would have been ideal, the reality is that the industry already had these long-term secular trends. We were already shifting to fees and have been for 20 years. We were already shifting to more of, the independent fee-based model and shifting to a fiduciary approach. If I go back to the stockbroker that I was in, when I was 24 years old or whatever I was, if I'm really honest about it, I wasn't a financial advisor. I would have no right to have called myself that. I was a mutual fund salesman. That's what they trained me to be. Well, the industry has been transitioned. We didn't have discussions back then about, structuring an overall plan and, capability for your clients. You wanted to sell them a mutual fund, if we're really honest. So the whole industry has been shifting over to this approach where it says, I'm going to do the right thing for my client instead of just sell them a product. So that trend has already been underway. The growth of the independent RIA market, the shift to fees, and the uses of a fiduciary approach and an expressed concern for the obligation to do the right thing for your customer. DOL simply accelerates those things. So your listeners in the RIA channel were simply ahead of the curve.
Right. But the concern that I have that I'm not sure a lot of folks are talking about is the fact that that used to be our differentiation factor, was that we were different, that we did break away, that we were ahead of the curve. And what DOL just did was force everyone into our space. Now, a broker at Merrill Lynch gets to call themselves a fiduciary. We could argue about whether they're always a fiduciary or not and the nuances of that. But it'll be interesting to see the reshaping of all of that. And, you said you came from Cetera, and I know the LPL getting bought by E-Trade rumor got dropped onto the newswire a couple of days ago. Who knows if that'll be accurate? But
yeah,
is there a space for broker-dealers, independent broker-dealers in the future? Or is DOL just honestly going to gut that model and they all end up being just giant RIA service platforms?
I think there's a space, and I think your listeners will still differentiate themselves. And I'll see if I can illustrate that. I stood in front of a group of 300 financial advisors a couple years ago and said to them, if your business model is building portfolios of mutual funds for customers and charging 100 basis points for that service, you're already obsolete. You just don't know it yet. And I was mobbed afterwards. Advisors coming up and saying, you're right. We all know it. So what do we do? That's what's going on in that space, is people that were the mutual fund salesman that I was 25 years ago are realizing that they need to shift more to this approach. But that's going to be a different person than your listener who has their CFP and has gone out and perhaps even gotten their CFA and has been doing this approach for years. I think what's going to happen, and we're seeing it happen, is there will be a spectrum of a level of control and discretion that advisors have. And the more advanced and well-trained that advisor is, and perhaps depending on the type of firm they're working for, the more flexibility they'll have in how they work with their customers. Large firms with large numbers of advisors, especially when those advisors are less well-trained, for example, the Series 6 guys, are very likely, I believe, to end up in a world where using technology, they are walked through a process that is very much homogenized for their customers, and it'll be a conduit for delivering professional advice. But that professional advice is not coming from that advisor. They're delivering professional advice that's coming from the research team in the back room and is delivered through technology and administered and explained to the customer through the use of illustrations and proposals and all sorts of things that we do. And that way, firms can guarantee that good quality advice is being delivered, and that service is going to be needed for a long time.
Right. That's sort of the current Edward Jones model, not to pick on them, but that's what I have heard from their advisors, that, I'm an advisor, I check boxes and it tells me what to say. So that's sort of that side of it.
That's probably fair. And so I guess the point is that there is a role for folks who are, the guy I was 25 years ago, but I would have been more effective had I received more support, more help,
sure,
more of being given the advice that I should deliver, because there's an important role of explaining those concepts to your customer, being there to hold their hand, helping sure they understand why it's important to diversify and invest for the long term and all the things that we sell all the time. So there is still very much a role for the human financial advisor. And when you're talking about a business that's serving smaller accounts, average 100,000 even, that very much makes sense. The more that you move to the other end of the scale, where you're dealing with high net worth customers with complex needs, the more the advisors will need to be highly trained and very well experienced in how they deliver, and the more flexibility they'll have. But I think that's what you'll see, is that the industry will become more homogenized, more delivery of professional advice, and the advisors down in the less expert end of the chain their role will be much more about relationship management and the delivery of that advice. And then there'll be a whole continuum up to the high net worth where they're doing very complex things.
So I know there's a lot of fear of commoditization of investment management fees. So are you seeing the fee compression that everyone has talked about is coming, or, that robo-advisors are going to cause a fee compression on the AUM side? Like, is that real? Are we actually seeing it happen? Or is it just, I guess, the fear mongers just out there, being afraid of what technology is going to do to their business model?
Yeah. Well, it's happening, but it's not happening in the way that a lot of people talk about. If you look at the rise of passive investing and the use of ETFs, that's the way it's happening. The traditional 100 basis point fee for explicit advice has been remarkably durable. But in order to keep fees to the customer in line, the cost of the underlying investment vehicles has driven down. And that's the way most advisors have figured out how to do that. That 100 basis points has been durable. And I would argue going forward, advisors have to connect the value that their client receives more directly with the services that are associated with it. So that was my comment earlier. If you're getting 100 basis points in order to pick 6 mutual funds and put them in a portfolio, well, that's not worth 100 basis points. But most advisors are probably doing much more than that. They're probably meeting with you once a quarter. They're perhaps doing at least some lightweight financial planning and maybe a full-blown financial plan. Maybe they're even talking with you about what your estate planning is and recommending attorneys. But you're not explaining to your customer that that's the level of service that you're paying for. So the key is the areas where the customers receive value is what needs to be connected more to that fee in order to preserve that fee. And I happen to believe the primary value of a financial advisor is not picking which mutual fund to put them in, but in the behavioral coaching and in the financial planning and the discipline that you instill in your customers to, frankly, sometimes just save more money.
Couldn't agree more. I mean, and I've always felt like it doesn't matter if you can add 2% of alpha to your client's investment portfolio. If they sell at the bottom of the market, everything gets wiped out.
That's right.
I don't care how many years you beat the market. A down year and a sell they don't meet their financial goals. And what we're starting to see now, and obviously we're on the front end of this, or trying to be anyway, is that, kind of that spectrum you talk about where there's, really basic planning that's kind of being spit out by a piece of technology all the way up to the high net worth space, that our folks are trying to do both, where it's saying, hey, I want to do that comprehensive financial planning, just like we do for high net worth, but I want to do it for people that don't have money. And that's kind of where that we're fitting in to say, hey, you can charge a flat monthly fee. You don't have to only think about this 1% AUM, that you can just charge a fee for planning. But you've got to be able to describe the value. And historically, we have, as an industry, we have been awful at describing the value of financial advice and behavioral management, because it's hard to say, like, no, trust me, like one day you're going to try to step off the cliff and I'm going to save you, because clients don't experience that until they're there, and then they wish you had been there to save them. So y'all have this really cool concept, I guess, and one that we definitely support, but I love the way you frame it, called Fiborg. Tell listeners about what Fiborg is and what it really means, I guess, for their business and kind of the industry and where we're headed.
Well, here's the idea behind that is that technology, for all the discussion out there about robo-advisors and are they going to replace the financial advisor and make us irrelevant, or I think that's nonsense. And I believe the use of technology is now and always has been to enhance what human beings deliver. Because the value, if you believe the value is the relationship and the behavioral coaching and getting your customers to do the right things, well, then let's use technology to make you more effective at that. Whether it's the illustration products that I created 20 years ago, or whether it's taking care of automating basic tasks like rebalancing your portfolio like we do today, or even online account onboarding, operational, mundane tasks that add no value to the client relationship should all be automated, which makes the financial advisor more effective at doing what they ought to be doing anyway, which is telling me how to behave and how much I should save and how to plan for my kids' college. So that's the idea behind Fiborg. I always felt robo-advisor, even the analogy is rotten, because robo, that refers to robots. And what do robots do? Robots replace human beings. I don't believe for a second that's going to happen in this industry. The human being will always have a role to play. So instead of the robot as the analogy, I started thinking of, the right way to think about this is like Iron Man. And the character Iron Man has a technology enhanced suit that makes him stronger, better, faster, better at what he was already doing. That's the role of technology. And so I asked my marketing department, I charged them come up with a word, a term that encapsulates this concept of technology being about making humans better rather than replacing them. And that's the path they went down, was this idea of the cyborg, which is the technology enhanced human. And of course, we have the financial component. They came up with Fiborg. And I think it's just genius. And we have a lot of fun with it.
I love that. And I will say that I love your Iron Man kind of metaphor instead of the cyborg model, because when I think of cyborg, I think of Terminator, and that's a bad thing, right? It's humans and technology. Basically, it's the technology taking over the world and augmenting humans, whereas Iron Man is a much more positive spin, which is a good thing, because I agree that, for all the talk about robo-advisors, and for a couple of years, all we heard at conferences was, how do we survive the robos? And we're finally starting to see that conversation die down a little bit, because I think people figured out Betterment and, Schwab's institutional portfolios and all these other pieces. It's just really, really sexy rebalancing software.
Yeah.
I mean, Betterment has an algorithm that block trades like 100,000 accounts at once, which is awesome. It's really cool that they brought that in. They have one-page account opening. But if that's all, if as an advisor, your true value is that you open accounts better than anybody else, yeah, you're in trouble because Betterment can do it in one page.
Well, I couldn't agree more. And at the end of the day, I'm sure a few of these robo-advisors will survive. Probably the big ones like the Betterments and the Wealthfronts. There's a place for them in the industry, just like there's a place for self-directed brokerage accounts. And they're valuable for the right person. I'm actually kind of a perfect customer for a robo-advisor because I've been in this industry forever. I don't need some of the things that financial advisors offer, but I love the idea of having my accounts automated and traded on a regular basis.
Fair enough.
But the person who doesn't really know what to do with their money or how to plan for is just, they're still going to want to work with that human being. And the idea of humans being, we went through this before. Remember back in the early days of Schwab and self-directed brokerage, that was going to kill the industry.
Oh, yeah.
One of my favorite examples is, it wasn't that long ago, everybody was talking about internet banking is going to kill the brick and mortar banks. Remember that? And,
oh, yeah.
They were all going to go away and there were going to be no more teller jobs. And there's a lot of teller jobs out there in the world, but the internet banks led the trend. They put this technology out there where people could do it online. And now every bank today has an ATM and they still have a teller on the inside. But the key is the internet banks led that trend and showed that the technology works and that it's desirable. Once Bank of America got the religion and said, hey, this might not be a fad, and they rolled out internet banking, they were opening more accounts than NetBank had opened in their entire 5 years of existence. Every 90 days. More accounts than NetBank had opened in 5 years. So that's what happens. New technology comes out. It kind of gets beta tested by these entrepreneurial firms that have, that are nimble and courageous enough to roll out and run these new ideas. And then the big firms go, oh, customers want that? Okay, well, we'll roll that out too. And that's what you're seeing now. It's kind of the robo-advisor phase 2. And that's part of what we're in the business of doing, is providing that robo-advisor technology and all the back office and everything that goes along with it so that institutions can provide their own. So you'll find in 5 years, maybe 2, every financial advisor, every financial institution will have a robo-advisor capability. And all that really is technology-based customer self-service, and it enhances the service that's coming from the human.
That was going to be my question. I totally agree with the way you're framing this. I'm not sure I've ever heard it this way, but like Robo, 1.0 was the Betterments and the Wealthfronts, and they built out this cool tech that you had to go to Betterment to get. Robo 2.0 is that the custodians are now rolling out their own robos. Schwab has one. TD Ameritrade just announced they're launching one. Some of them are for advisors, some of them not. But so now the big players are getting into leveraging it. And so it sounds like in your mind, in another 2, 3, 5 years, we'll kind of be at that Robo 3.0, which is that we're no longer talking about robos. We're talking about just technology to better run the investment management process inside of our firms, and everyone will have it. It'll be ubiquitous. And then something else will be coming out that, is vying for disruption the way that the robos have for, over the last couple of years.
All that's right. The only difference is in the 2, 3, 5 years. That's the 2, 3, 5 years when it'll be ubiquitous. But we're rolling it out now. I mean, we're now talking to large institutions with thousands of advisors, and we are providing them that quote unquote robo capability. In that, whether it's 5 years or 2 or 3, who knows? But every financial advisor will have a website where a person can go to directly, receive some basic financial advice, perhaps do some lightweight financial planning, interact with it, and even open an account. And they might have different service levels. Maybe there's, once they get up to a higher account level, well, now maybe once you're above a certain asset level, you now get quarterly meetings with the financial advisor. You now have access to financial planning services. Things like that, where new service models that we haven't thought of today will be defined in this space. And that's happening now.
So I guess what are you seeing? So we have the robos, that robo technology. We know what they brought to the table. We know how that's getting integrated. I guess especially for the smaller RIAs who we are more nimble. We don't have to go through we don't have the pains that a broker dealer has of trying to implement a new technology. What's the new tech that you're seeing coming, or kind of what are y'all working on developing or see that's interesting that will affect the way that we're doing business in another couple of years that we need to be preparing for?
Well, it's this Fiborg idea is how do I use technology so that I can more effectively do what I already do? So what do financial advisors do today? They collaborate with their client. They provide guidance. They teach. They educate. They coach. Sometimes they give them a shoulder to cry on.
Sure.
We will do those sorts of things with technology now. And then customers will choose to what extent they want to interact with me by technology or interact with me. Let me give you an example in the insurance space, right? I buy my car insurance from Liberty Mutual. And one of the main reasons I chose that company is because I liked their web-based capabilities. I could do a lot with them over the web without having to call and talk to a person. And when I go buy a new car, the ability to go on the website and put that new car in without having to call a call center, to me, that's very valuable. But when I needed to talk to somebody about a personal umbrella liability insurance policy and how much personal liability I have against my own assets from my business or some of the side investments I do, I needed to talk to an expert, and I wanted to talk to a human, and I didn't want a website for that. That's what's going to happen in this new world. So if the customer wants to simply go out and look at some different model portfolios, do some lightweight financial planning, even open their own account, as an advisor, they might be able to do that on my website without me. But when they have a question about, how aggressive do I really need to be to make sure I can educate my child who was just born? Or, how does this tie into, I have a family member who's ill and how do I need to plan for that? That's not going to happen online. So the key is technology should automate and deliver things that can be automated. And advisors should not be afraid of that. They should embrace it. And in fact, we have a capability we're working on now where the advisor will be able to just email a link to the customer to say, hey, if the customer is predisposed to this, go through this. It'll take you through a questionnaire. It'll sort of help you figure out where you are on the risk tolerance scale. And you might learn a few things about yourself, and it'll show you some concepts with models. You go play with that and have a good time. And then we'll sit down and talk. And then by the time you sit down and talk, that person has been through, an assessment process, has gotten some basic education, has maybe done some basic planning. Now you're starting from a point where you're already pretty far down the path towards a really meaningful relationship, and you've spent 3 minutes with that person, right? It's a different model.
Yeah, it's just amazing where I think technology is in financial planning versus some of the other industries. Like I'm still confused as to why I can't go into my CRM, hit open Roth IRA, and just everything that needs to happen just happens because all the data is there, right? Like it should be able to trigger a form, gets electronic signature, and then in account is open. And we're just not there yet. So it'll be interesting. And I know we're talking about these big kind of overarching industry trends with client questionnaires and things like that. I don't think enough people are focused, or enough technology vendors are focused on some of those little things that do add up. But once we start solving some of those problems, we're really going to be able to, I think we're going to be able to serve a lot more clients because from an operational efficiency standpoint, we can open accounts a lot quicker. We can be sure that ADVs are being emailed out annually and that, that we're tracking all that because right now everything is done. It's such a manual business running process that I think we're in right now. And I think that there's a lot of talk about planning software and investment management software and things like that. We don't have a lot of conversation around business management software and automation and true workflow management, which I'm excited to see come down the pipeline. It just seems to be taking forever. But fortunately, like Fidelity buying e-money, LearnVest getting bought for absurd amounts of money by Northwestern Mutual, all of those things are good for us because I think it does show that there's money to be made in tech and financial planning, and maybe we will continue to get more investment from the venture capitals of the world that see that we do actually need some help when it comes to our technology because, man, are we behind.
I agree. Not only are we behind and practices are way more manual than they should be, which is why people should embrace automation. But on top of that, I would say, if we're really honest with ourselves, the user experience, to use that term from the technology world, that our industry delivers to the end customer, it stinks.
It's horrible.
It
really is.
You got statements coming at you from all different directions. A lot of times we don't even tell you. I remember being, back to my Legg Mason example, when I was 25. I went to my branch manager one day and I said, so I see the statements the clients get, but how do they know the actual returns or the performance that they've gotten out of what I've recommended for them? And he said, oh, they don't. And it was jaw-dropping for me. We don't even give them a report card. How can that be true? But it's still true in a lot of places today.
It is.
So, and customers have all this paper coming at them that has no value, like all these prospectuses that they throw right in the trash. But yet we're not giving them simple websites that say, hey, here's how you're doing. Because that's what they want to know. Am I on track? Am I doing okay? Are my investments good enough that I'm going to be able to retire and educate my kids? Those are the sorts of things where technology has got to fill those gaps. And we're seeing a lot of progress there. And that's the sort of thing that we're working on.
Totally agree. And I mean, this is the fact that, I had clients when I was running my practice that have 4 different places to sign into something. I mean, they've got risk tolerance questionnaire login. They've got data gathering login. They've got planning software login. They've got investment management login and document vault login. I mean, it's just amazing how disjointed our technology has been. And now, I am a believer in basic Econ 101, supply and demand, and that is that the demand really hasn't been there because advisors are so slow to adopt technology that you don't just have to make, you don't have to be better than the competition. You have to be 10 times better to get an advisor to actually adopt technology. We have so many that are coasting into the sunset that just don't care.
Yep.
They can have DB cams and Goldmine running on a server in their, back office, because apparently those systems still exist.
They do.
They can just live with that and move on. And, our group of advisors are saying, please, give us a 1-page account opening form so we can leverage it. But it's hard to make software that, thousands of people aren't buying yet. So it's a chicken and the egg, which I think is coming. And it sounds like, y'all are on the forefront of this and you're seeing some hope, I guess, for the advisors out there that the technology that just makes sense, that just we need to have, is coming in addition to some of the other pieces that are going to be really nice to have, like more streamlined on the investment management side.
Absolutely. And that's been the I see more and more people, and not to be sort of stereotypical here, but usually it's the younger folks that are thinking this way. And I've had some great conversations with the financial advisors that are in their 30s that get this and fundamentally eat, sleep, and breathe how this is going to work, and are thinking about how to deploy technology into their practices to give a better experience to their end customers. Because that's what's coming. And think about it. Instead of advisors being scared, what if this technology could solve the problems with fee compression that we talked about earlier, solve the problems with the customer experience, which means maybe I spend a little bit less time individually working on each customer because I've automated so much of what they do, but the value of what they receive from me is so much higher because they've chosen where to interact with me. And through those things, I've expanded the capability of how many clients I can serve from 100 to 1,000, maybe, So there's just different ways of looking at the way that we're going to deliver financial advice. And that's the way people need to be thinking. And there are people out there that are looking at it and are leading that. And it's a lot of fun.
I love it. It's so cool to see. I mean, you are coming at this profession from a very different angle than I am. And it's really cool to see that we're kind of seeing the same thing with different groups of advisors. It'll be interesting to see in 3 to 5 years to revisit to see how close we were with our predictions. But I do think we know things are changing. We know things are changing really fast. We'll kind of close out today's podcast. I'll put you on the spot and say, if we could go back to Steve, maybe that's the stockbroker, or maybe the Steve that's pursuing different opportunities. If there's one piece of advice that you wish you could go back and give yourself, kind of that one thing you know now, wish you had known then, what do you think that one piece of advice would be?
Don't try too hard to get better at the things that you're just not naturally good at. And what I mean by that is I think one of the most valuable traits that anybody can have is self-awareness. Know who you are, know how other people experience you, and know what you're good at and what you're not good at. And I think too many people spend too much time focusing on the things that they're not good at and trying to be better at those. instead of figuring out, well, here's what I'm really good at, and I'm going to focus on that because that's what's going to make me successful.
I love it. I'm a huge fan of Strength Finders, the book and the personality exam. And that's really its core philosophy is, out of 34 strengths, these are your 5. Be really good at those 5 and then hire or surround yourself with people with the other 29 strengths, because it's hard to become really good at something you're really bad at. There certainly can practice and work on that, but if you have a gift, you might as well leverage it, make it your superpower instead of, focusing on how to overcome your weaknesses. So
that's right. Well, and if you try to get, you won't. I forget whether it's left brain, right brain, but I'm not a math guy. I'm not a natural numbers guy, which is a weakness for a business guy. Let's be honest.
Sure.
And I spent years trying to be that guy who can sit in the meetings and do math in his head and quote numbers out of the P&L at will. And you know what? And I never could, because it's not who I am. And so when you try to do that and you're not good at it, you're going to look foolish. So I finally said, look, what I'm good at is crafting that vision, hiring the right people, getting people motivated, and putting together a team where the right people are in the right roles. And I'm going to focus on that. And I've had far more success with that approach. And if you're not good at numbers, you make sure you got a damn good CFO at your side and, hire to your weaknesses.
I think that is just absolutely critical advice. So, Steve, thank you so much for taking the time to come on this show and share your kind of career path and wisdom. I really do appreciate you taking the time.
It's been a pleasure. I had fun.
I know this interview was a little different than our typical guest, but I really enjoyed hearing an outside perspective on where this industry is going. Having never worked on the independent broker-dealer side of the house, it's always interesting for me to hear how they're operating, their concerns, and kind of what they're bracing for. And Steve's certainly an expert there. And Folio, as a tech company, is investing heavily to ensure they're relevant for the coming changes in the industry. So seeing where they're focused gives us a glimpse into the possible future of financial planning. FolioDynamix is leading the evolution of the wealth management business with technology and advisory solutions that empower every advisor. FolioDynamix just launched the concept of Fiborg, which covers those advisors who embrace technology automation the same way the cyborgs of science fiction did. That Fiborg concept means that advisors can automate those activities that don't generate revenue while maximizing the time they spend with clients. For more on Fiborg, on working with millennials, and on FolioDynamix, visit FolioDynamix.com/thought_leadership. Be sure to join our VIP community at XYPlanningNetwork.com/VIP to hang out with other XYPN Radio listeners, ask questions for future mailbag episodes with myself and Kitsis, and to finally find a community of like-minded financial advisors. Thanks so much for joining me today. We'll see you next time.
You're not alone, and you're not crazy. It's scary starting, building, and growing your own financial planning firm. And that's why we put together a free private community just for you, the Cutting Edge Financial Planner. Go to XYPlanningNetwork.com/VIP or text XYPN Radio to 33344 and join a network of thousands ready to change the lives of Gen X and Gen Y clients.